Hi everyone and welcome back to our channel and welcome to Lendy's first financial and property update for 2022. In today's video we're going to be discussing the latest trends in the property market, RBA Governor Philip Lowe's comments on the potential rising cash rates, and whether the recent development in Europe might have an impact on the Australian economy. I'd also just like to take this moment to acknowledge the topic of the recent floodings in Queensland and to let you know that our thoughts go out to anyone and everyone affected. If you are someone who is affected and you're unsure of what to do, please reach out to your bank or lender's hardship department and they will always be ready and able to assist you. But with me today, we welcome back David Hyman, our co-founder and CEO of the Lendy Group. Welcome back, Dave.
Thanks, Sarah. Great to be here as always.
Let's dive right in. Could you maybe do a quick overview on how the property market has performed at the start of 22, given we haven't actually had an update since the end of last year?
Yeah, absolutely. It's always a great place to start. And, in what I describe as our nation's de facto national sport, there's been some really interesting developments. So typically January's a slow month and we have seen less stock on the market in January than other months. But if we compare this January to last January or other Januaries, we've actually had a really busy period. So there's been significant levels of stock across all capital markets. There was over 1,400 results and reasonably high clearance rates at over 74%. We also saw 5 of 8 capital cities record modest increases in the monthly growth rate in January, including Melbourne, which had previously seen a decline in December. And in aggregate across the whole CoreLogic national measure of housing values, that rose by around 1.1% in January, up from December result, but certainly down on the peak that we saw last year in March. Playing that through into sort of last week, we've seen those clearance rates bounce back. We had over 1,800 homes taken to auction, which is up 53% from the 1,100 held the previous week, and strong clearance rates in the 70% range. So we saw obviously less government stimulus. There's potential rise in interest rates as well coming down the track, which no doubt we'll talk about today. And obviously the price rises mean declining affordability, which I think over the long run are going to dampen the rate of growth, albeit we don't expect anything significant. And in terms of capital gains, we're seeing both Brisbane and Adelaide leading in capital gains, in particular in their regional markets, as people take advantage of things like flexible working.
Nice, starting to see the shoots of reality coming back post the pandemic. But moving on from the housing market side, RBA Governor Philip Lowe, in a conversation with the AFR, I believe, at the start of February, made some really interesting comments, basically hinting at a potential rate rise. He sort of warned homeowners to build a buffer to prepare for future rate rises. Pretty cryptic message. Keen to hear your thoughts on that, Dave.
Yeah, look, I think everyone knows that the RBA has basically publicly signalled that rate rises weren't going to happen until 2023, 2024 sort of time as the economy unwinds our kind of emergency level setting at the moment of 10 basis points. We're clearly at the lowest level we've ever been at in history, and that has to unwind at some stage. The key things that the RBA is looking at when they think about when's the right time to unwind are really the inflation numbers. So both inflation on the CPI basis, so looking at the basket of goods that people commonly buy and how is that moving in terms of price, and then also things like wage inflation. We've now had a couple of quarters of inflation data, which is certainly at the upper end of the range that the RBA talks to, being 2 to 3% on a sustainable basis. But in the last update, we still hadn't yet seen that properly come through into wage inflation. Wage inflation data actually came out last week, and we're seeing wage inflation pretty close to that 3% range and sort of the high 2% range, albeit this is the first time it's been at that elevated level. So I think with all those things together, it makes sense that Governor Lowe was sort of starting to hint at potential rate rises, and now most economists are predicting they'll happen in the second half of this calendar year. So, as early as June, if you're sort of looking at the start of that period. What that means for mortgage holders, you should be planning for potential interest rate rises coming down the pipeline. And obviously, if you're on a variable rate, those rate rises will impact you depending on how old the product is, how long you've had the loan for, and which lender you're with will impact you in different ways. Sometimes the whole amount of the rate rise is passed on, sometimes more. But really what we'd recommend people to do is if you haven't reviewed in the last 12 months in particular, it's a really good time to review and potentially consider fixing. There's still some really competitive fixed rates out there in market in the low 2% range. And depending on where your variable rate sits today or which lender you're with and how they treat variable rates historically, you could potentially fix part and leave some in variable if you wanted to sort of hedge your bets, so to speak. But very much, budget in for a rate rise because, all signs are pointing to something happening in the second half of this year.
Some really great insights there, Dave, as always. And just a reminder to our viewers out there, if you do want to talk to a specialist in this space, then our Lendy Home Loan experts are here to help. They can give you a lay of the land and talk about all the various options available to you, particularly if you are a little bit nervous about the potential of a rate rise in the next kind of 6 to 12 months. Dave, I'm just going to caveat this next question with the reality that we are actually recording this just at the end of February, so no doubt by the time that the viewers are watching this, things may have shifted and changed. But there is obviously some news coming out of Europe regarding Russia and Ukraine. There's a lot of volatility that creates in the stock markets, particularly around commodities. In your opinion, does that have any impact on the Australian economy and or borrowing costs? Or are we pretty well buffered here?
Look, I think I'd like to maybe start with this one. As you said, we're sort of filming this at the end of February and the news is relatively fresh. Firstly, our hearts go out to everyone either in Ukraine or with connections to Ukraine. It's just horrible what's going on over there. But I guess playing that through sort of economically, we've seen a couple of those things start to shoot into global markets. So we've seen the price of oil go through the roof. It's broken through $100 a barrel from after being sort of more in the sort of $60, $70, $80 range more recently, which is clearly going to push petrol prices up around the world. In terms of the impact on our economy and borrowing costs, I think as you called out, I think it's a little bit too early to tell, just given where in the first few days of this conflict, and we'll certainly keep an eye on it as it unfolds. But I guess as a general rule, the Australian economy is reasonably well disconnected from Russia's, and as is our geopolitical stability and certainly our housing market. So we don't foresee any, in particular in the short term, based on what we're seeing at the moment, any major impacts. But I guess this is an emerging conflict, and we're just going to have to keep our eye on it, as no doubt most of our viewers are doing at the moment, as it continues to unfold.
Thanks, Dave. Again, some really great thoughts there, and one for us to watch. I do caveat again, we are filming this just at the end of February, so no doubt things will have shifted, hopefully in the more positive in the coming few days and weeks. That does conclude our February monthly update. I just want to reiterate again, if you are in Queensland and you are affected by the floods and you're not sure what to do, please do get in touch with your lender's hardship department, and this can be found on their website, and they'll be able to assist you in what those next steps might look like. Hopefully we'll see you again soon. Take care and stay safe.